Good afternoon, everybody. It is Monday, August 12th, halfway through the month. It's afternoon. This is the first time I've done Facebook Live in the afternoon, I think. Yeah, I'm running super late today, a bunch of stuff going on. Back in my Scottsdale home office. And for those of you that were paying attention, my last Facebook Live from my Scottsdale home office, we were talking about the mean old ugly owl that used to sit over my shoulder, and I got feedback that that mean old ugly owl was distracting, and so I said I will change that picture every day that I'm in this office, and so. On the next day, I did the frivolous bear, which is a super happy, really colorful bear. I really like that painting. And today, I forget what we have. Well, I forget what this. Don't forget what this painting's called, but it's actually one of three paintings. And the one that's on the wall behind me, that's the male donkey, and the two other ones are two female donkeys. And the female donkeys are looking over their stall, flirting with this male donkey. And I forget what it's called. It might be called Flirtation, I think, the series of three of them. But so today's donkeys. Now, normally I'm going to put paintings that aren't of animals. It just happens that that was the easiest one at hand. And I'm looking forward to your feedback on which one you like. So we've done the Angry Owl and Frivolous Bear. And now I think Flirtation is what this one's called. And tomorrow I'll have a totally different painting. Okay, now, late Monday. Let's get into it. I've been wanting to talk about interest rates now for some time, and I love the topic of interest rates. And I think as mortgage and real estate professionals, we need to be well versed on interest rates, and we can't just punt. 20 years ago we used to say, "Gosh, if I could predict interest rates, or if I knew interest rates, I'd be a rich guy." Or, "Oh my gosh, the Federal Reserve has 400, Harvard PhDs, trying to understand fiscal policy. They can't get it right. How in the world can I get it right?" So, as you know, I'm a huge advocate for adopt an economist, or at least an analyst, or a publication, and quote them. Even if you're wrong, which, by the way, recently I've seen a whole bunch of inaccurate quotes or inaccurate analysis on the Spawn rule, which is okay. Even if you're wrong, at least you're basing it on some sort of known expertise. So keep quoting. But today we're talking about interest rates, and what I want to talk about is the misconception, and I will just keep hammering on this, on the misconception of the Fed's ability to influence short-term interest rates. And what I'm talking about, the whole market is clamoring for the Fed to cut interest rates, right? Like, cut interest rates. We want you to cut interest rates. And the Fed is being hesitant to do it, right? And we go, "Gosh, why won't they just cut the rate? Why won't they just cut the rate?" And the Fed says, "Hey, gosh, we can't cut the rate because of inflation, right? And if we don't get inflation under check, we will lose our credibility, so we have to fight because of inflation." But you know what the truth is? The truth is the Fed doesn't set the interest rate. Not at all. The market sets it. Let's say the Fed sets the overnight cost of funds at 3.5%, or 2.5%, or 1.5%, and there's no buyers. What happens then? See, because the United States doesn't have an option of not being able to sell its debt. It has to sell its debt. It has to fund its government, right? It has to sell all this debt, this, $1.4 trillion debt a year, 1.5, and it has to recycle through the debt that's paying off, right? So it has to go to market with a ton of debt. The issue isn't what the Fed thinks that they should target, what interest rate should be targeted. The question is, what is the market willing to pay? And so we saw that last week, right? The economic, all the indicators are somewhat weak. Inflation is going down. Jobs report wasn't good. All this weak indicators, and the market loved it. The market's like, okay, rates are getting better, inflation's getting better, right? Until midweek last week when we had the two auctions, and we didn't have a great bid cover ratio. Or put differently, it was a very weak auction. Where we're getting to the point where there either wasn't enough bids, or that we needed a higher interest rate to attract the demand, right? And that's the problem, because the Fed can't lower rates lower than what a market's willing to get. And we're going to face that this whole year. This year, we're going to face where the market isn't going to accept rates that the government is offering. And then you know what the government's going to have to do? They're going to have to change the rate. You're going to go, oh, I was just joking. I didn't mean 1.5%. I meant 2.5%, or whatever it takes to attract the market. And it's complicated because there's so much volume coming to the market, right? So the Fed does not set the rate. The market will set the rate. And that's what happened last week. The debt didn't sell well. We needed to increase the yield to attract, buyers of debt, and that's what stalled our, that trend of interest rates improving. Now we're back on that trend a little bit, but this is going to be a problem all year long, and I want everybody just to be aware of it. I posted a newsletter today from Torsten Slok. Dr. Torsten Slok, I've talked about him repeatedly. He must have 2 or 3 different subscription services. One's free, puts out this great content. And the one I shared today, the name of the newsletter was Weaker Demand for Treasuries. And he looks at this differently than how maybe I've looked at it in the past, because in the past he just looked at bid offer, right? Like, okay, we're offering $100 billion in 10-year notes. We got $160 billion in offers. That's a pretty strong market, right? That's bid to offer. What Dr. Slok actually reviewed, what was called the tail, or it's called the tail on a new bond. And you can use that to dictate how much appetite there is for bonds. And he shows you this, I think it's a 20-year chart or something. I don't know. It shows you a 10-year chart of what the demand has been the last 10 years. And what you can see is that the government's having to put its highest premium or highest yield on these bonds to sell them that they have had in the last 10 years, which just speaks to a really weak market, and that the federal government will have to continue to push yields up in order to sell this debt. And then that affects us, right? Because we're downstream of that as mortgages. We got to compete for that volume. And if treasuries start paying more, then people will go to treasuries instead of buying mortgage-backed securities. Make sense? And that's another reason why the spread between the 10-year and mortgage-backed securities are high, right? So the market's starting to demand more yield, and you go, gosh, so we need to pay attention. We need to pay attention to auctions. We need to pay attention to what was the result from the auction. We need to be kind of conversational about offer bid and about these price tails, right? And historically how it's going. Really interesting. So pay attention to that. And it's very much like people ask, oh my gosh, the U.S. government is so stupid. Why didn't they sell 30-year bonds when interest rates were down near zero, right? Like, why were they doing short-term bonds, right? It's because they didn't have any buyers. That's why. It's that simple. The government isn't that dumb. If they could have unloaded trillions of dollars in 30-year fixed product, into the market in 30-year treasuries, they wouldn't. They didn't have a market, and that's why they couldn't do it. It's as simple as that, right? So sometimes the most simple thing is the most obvious thing. Check out Dr. Slok's newsletter. I did a LinkedIn post about an hour ago. I put a link to this letter, but I want to touch on something else. So if we say, gosh, the Fed doesn't have a lot of power, right now the Fed tries to have influence, and it does it by sending signals, by telling it what it's going to do in the future, right? And then it also does it by trying to set the targeted interest rate. It does it as a bystander, right? But as we know, the Fed in the last decade or two has been very willing to come off the sidelines as a bystander that just has influence to become a market participant. Right? And when we see the Fed become a market participant, how you can translate that is into quantitative easing, QE. QE is when the Fed stops from being, I'm going to influence rates to I'm going to manipulate rates, right? And now I shared an article a couple weeks ago called Fiscal Dominance. It was awesome. It was probably one of my favorite articles I've read in the last 6 months. It was by Michael Leibowitz from RIA Advisors. The name of the article is Fiscal Dominance. Fiscal Dominance is here. I put a link to this article in the same LinkedIn post with Dr. Slok's article on these short-term rates and the bid versus offer information, the bond tails, right? But fiscal dominance, what Michael Leibowitz argues is that, look, we're going to head into a period of QE. All right, the Fed is going to come off the sideline as a bystander and get back into the business as a participant. They're going to do it 2 ways. The first way they're going to do it is that they're going to just go back to buying bonds, just like they did during the last 3 QE sessions, right? During COVID and during the great financial recession. They're going to go back. As a matter of fact, when I originally covered this article a month ago or 3 weeks ago, what Michael Leibowitz shared is that in the Fed's budget for their SOMA portfolio, SOMA is their holdings. It's just a holding facility for all the Fed assets, that they're budgeting for a 40% increase in those assets over the upcoming few years. And they're currently at what, $7 trillion or something like that. And so they're telling you we're about to go on a buying spree. They're publishing it, saying we're going to go on a buying spree. And what that's telling you is they're going to implement QE, and they're supposed to start. So I think in the budget, they start to acquire assets at the end of this year, right? So QE is coming. While the Fed is becoming ineffective, influencing interest rates, they're going to convert to manipulating interest rate. And what they're going to do is they're going to create more demand by entering the market themselves, right? And as we know, at the top of, I think, QE2, the Fed was buying 60% of all bonds or something like that, all treasury bonds, right? So they're going to go back to controlling demand, driving down yield and interest rates. Does that make sense? The other thing, too, in that article, which is super fascinating, they're also going to influence banks to buy more treasury bonds, buy more government bonds. They're going to do this by, one, changing the liquidity rules. Think Basel III, change the liquidity rules so banks have to hold a lot more liquidity. And then they're going to give some sort of weighted value to having treasuries as that liquidity versus other assets. And then what they can do is they can go, look, we're going to give you 125% liquidity credit for every $1 of U.S. government bond you have. But then we're only going to give you 50 cents on the dollar for every mortgage-backed security you have. And so they could do weighted, right, liquidity rules that then entice the banks to go, oh my gosh, okay, I could put $1 trillion in, mortgages aside, or $1 trillion in whatever happens to be corporate bonds, or I could put $500 million in U.S. Treasuries. I'm going to buy Treasuries, right? And so they force them to have more liquidity, and then they coerce them to fulfill that liquidity requirement buying government bonds, right? Makes sense? And that's how QE will work. So while the Fed doesn't have control on the front side of interest rates, I believe QE is coming, and that the Fed is going to drive rates down. And the fiscal dominance is here. The whole argument, which isn't germane to what we're talking about today, but the whole argument is that the United States cannot afford its debt. It cannot afford its debt at its current interest rate cost. We can't afford paying $1.4 trillion a year in interest. And that number is going to go to $2 trillion very fast, right? We can't afford that. And so the best option that the U.S. government has is to drive down interest rates to lower that cost. And if they really drove the heck out of interest rates, drove them down, they could get that cost to below $500 billion a year. They might even be able to get to $300 billion a year. That's a far cry from $1.5 trillion. It's a big difference, right? And so everybody's motivated to solve this. The thing for you, don't get confused by bait and switch. Don't get confused by people saying the Fed has to lower rates, the Fed has to do this, the Fed has to do that. It doesn't matter. That's not going to influence rates, because if the market doesn't buy it, it won't matter, right? And so that's why we're going to get these whipsaws where, woohoo, bad news is good news. That's great. We're going to see Fed movement. And then 2 days later, the market reverses itself because the participants say, yeah, you might think that, but I'm not going to buy that debt. So what are you going to do now? But don't worry, because the Fed is going to come in with QE. They're going to buy, they're going to buy U.S. debt. They're going to force banks to, fund their liquidity with U.S. debt, and we will see some relief to interest rates this year, and probably significant next year, quite frankly. So that's what I wanted to talk about today. I am sorry about getting on late. Let me know what you think about the donkey. Tomorrow will be a different photo or different painting altogether. I hope you're off to a great week. Hope it's a super productive week. I hope you find this kind of helpful. Feel free to make comments. Let me know. I'm open to feedback, encouragement. With that, have a great day, and I will see you on time tomorrow. Thanks so much. Bye.